Trading Market Technicals morning call video for Wednesday, November the 6th. Dow Jones down 20, Nasdaq up 3, S&P down just under 5 points, and the Russell again under 5 points, about $4.69. This came about early on when the markets were down about almost 100 points, 100 Dow points. Buyers at dips came in and bought this market right back up again. So the euphoria of owning stocks is out there, and I must say, warning signs are upon us. Markets are overvalued. Markets are overextended. But again, that doesn't mean we want to go out there and just short the market, right? We want price to tell us that the market is indeed ready to roll over. So buying, hedging, buying protection, that is the wise and prudent thing to do at these lofty levels. Now, remember, we can continue to go higher, but I want to make a quick comment. I want to just briefly just show you. We have a 5-minute chart of the E-mini S&P future contract that expires in December, as you can see here. Now, this is a chart that is right now active, and the markets are up $7.25. And you'd be like, what is going on? So we are, let's see, it's about 3:30 in the, almost, well, actually, sorry, 4:20 in the East Coast. And waking up early this morning and seeing this and saying, what, this to me is a major warning sign. When you have markets that are up like this in the Asian session, and let me explain to you why. San Francisco Fed President John Williams on the wires in the overnight Asia session, and he quotes, "If you look at the valuation of stocks today compared to earnings and dividends and relative to historical averages, it's obvious that the stock market is overvalued. In fact, a lot of models will tell you that it's undervalued given how strong profits have been," unquote. That's exactly the type of rhetoric that would inspire fresh bids in equities. That, to me, is crazy. I mean, that is absolutely crazy. And if you look at the, if you look more importantly, his remarks, what he said, and he quotes, "Up until recently, I was thinking we would start seeing more of that self-powered growth in the second half of this year. Unfortunately, that really has not been happening, and we would have seen a real pickup. We're still a long ways from where we want to be," unquote. So obviously, the markets are just looking and taking bits and pieces of what his quote was and turned it into another rhetoric of buying. So I would be absolutely cautious of what's going on here, because the markets are obviously a disconnect of what reality really is in this new economy, if you will. And we all know the reason why the markets are up at these levels is because of the Fed. Now, that doesn't mean that you just don't trade, obviously, but I just wanted to point that out, and to point out why the markets actually just really literally just ran up like this and is up right now at $7. So there's definitely a word of caution that I would be saying, and I've been saying that for at least the last couple of weeks. Lots of warning signs, but again, we still trade what we see. We're trend traders. We follow the trend. The trend is indeed up, and that's what we need to find. But the problem is risk reward. Risk is more to the downside. Stocks are overvalued. There's no question about it. Totally priced into where we should be trading at, if not more. Number one. Number two is that if you're looking at quality stocks to trade, a lot of these stocks are up 50, 60, 80%, maybe 100%. So a lot of quality are now really, the market is in dire straits of pulling in to at least readjust and realign its overbought readings, and then look for some fuel, some more strength to indeed move higher. Do I see us moving higher at the end of the year? Yes, I do. But the problem is at these levels, and without a break, when the market does pull back, you're going to get a deeper downside correction, and that's something that really nobody would want, even if you're a bull or a bear. At least you want the market to pull back, side steps, and then move higher that way. Not straight up vertical in a line, trading 17 out of 19 trading days up, and with literally 2 days down. And yesterday, the market's even trying to come in, and it's people buying stocks again. So to me, you're gonna again, remember, I keep saying the markets are made to fool the masses. Please keep that in mind, okay? And when you have everybody loading the boat, buying stocks, and I think that's a good a good comment, loading the boat, and that's what's happening here. You have to be very, very cautious. Now is not the time to be buying stocks and adding to your positions. You should be buying stocks on pullbacks near support, near moving averages, adding to your position so you have a better average price. For those of you who are trading and swing trading, if you are swing trading, I would definitely be looking to add some protection. At any given moment, we can be down 20 handles in the S&P when you wake up in the morning. So just a word of caution. I'm not a negative. I'm not, I'm not a bull and or a bear. I trade what I see and I trade what the markets are giving me. And right now, to me, I've seen this before, and it's just putting out a little word of caution. All right. Anyway, but I wanted to show you how crazy the markets are when you have a statement like that, and really not even reading the statement correctly, and just everybody, in the overnight session, just come in and just literally just buy everything. It's just nuts. Anyway, okay. So I wanted to show you. I went in through in detail a lot of our indicators and the reason why that I'm very cautious. And I'm just going to go through a couple. New York Stock Exchange, new highs, new lows. Well, the markets actually pulled back and early on in the session and then rallied. Okay, well, new highs, new lows. We're still down ticking. Just wanted to show that to you. Another word of caution. Stocks above the 50-day moving average. Still on a sell signal. Starting to roll over. Down $2.40. Okay, so we're down at 76.60 now. Again, a perfect spot for the markets to move over. So if stocks are rallying and moving to new highs, if the market, is why aren't stocks? Because they're valued. They're fairly valued. They're overvalued. Stocks need to come in and in dire need of a break. Bullish percent SPX, we did get that sell signal. I'm going to put a line there tomorrow. Now, this could whip around a little bit, though. So we could be up today, and if we are up like we are now in the pre-market, this will probably turn back up again and probably just kiss this 8. But then we would see where we go from here, okay? But if you have the market, here's the SPX line chart at these levels, and the S&P now, this is the bullish percent S&P, we are on a sell signal. I'll put this line tonight for tomorrow's trade. We are now getting a sell signal. And this is pretty reliable. It goes off a point and figure chart. So this is pretty reliable, guys. Okay, new highs. Showed this to you yesterday. What's happening? The stocks are not making new highs while the indexes are. So they're buying the index. Another word of caution. Just want to show you that there is no change. New lows actually creeping up 9. Again, a word of caution. Now the dollar. Dollar is going to be a game changer if the dollar does pick up some momentum. Now, I do think right now it's just an oversold bounce, but we need to really keep close eye on the dollar here because the dollar is holding in from these lows. So this is something that I will be continue watching to see if the dollar does has a momentum, continued strength to move up higher and break above these two areas of resistance, which we did one. Now we just look at the top, and then of course the 200-day moving average is right above that. Okay, so keep an eye on that. The VIX. Mention about the VIX. VIX is back at all-time lows here. This is a big, big area of support, and it's going to be a big decision for the VIX. If we do break lower, I think even if we did break down to the 1250 area, I think you're going to get a violent bounce to the upside, again, which would put pressure on equities. And if you see here, we have positive stochastics. Now, we didn't get quite more of a turn on the MACD. RSI starting to curl back up above 30. Okay, just like we did here, we had some positive divergence here, and we actually exploded to the upside. So remember, keep this in mind. Watch the indexes closely. Watch the indicators on the VIX. I do have a funny feeling the VIX will start to move much higher. CBOE, totally bullish, extremely bullish actually. More calls being bought than puts, as you can see here. So again, a word of caution. Not saying not to trade. I'm not saying, step aside. No, absolutely not. But if you have, it's going to be far and few quality choices. But just stick to your guns, stick to your trading plan. Cash is a position. When in doubt, if you can't find anything, just step aside. You don't have to trade every single day to make money in this market. Okay, S&P daily. As you can see here, again, up 775. We are still hugging this 8. So the momentum continues to be on the upside. And I think that we have a logical spot, believe it or not, to actually test this 1618 extension. Now, that's going to be, we're at the 127. We're hanging right above it, which is acting as support now. So we're either going to roll or we're going to explode higher and catch this the 1618 extension, fib extension. When that happens, and if that does happen, I am going to actually be looking to short the market here. If the market does, of course, give us an entry and a trigger. We need a trigger. Remember, not because price gets up there, but this is going to entice me more and more to short the market back at these lofty levels here. Okay, so let's go right into it. Gold, no trade at the moment. Gold is acting terrible, and to be honest, I would not doubt we see this lower price being hit right here, 114.88 in a GLD. Remember, this is gold. We have a head and shoulders. That is the GLD, but follows the gold future literally to a tick. So I think I'd love to see this pop one more time back to that right shoulder where we can actually look to try to get a short in. Right here at this entry, risk reward is not really that good. So I like a better possibility short the market here, or a break of this neckline area and a back test. I look to short here. Right in here, anything can really happen. Where you got gap support in here, I wouldn't really be looking to short gold at the moment. So no trading gold. Now oil, very interesting. USO, which is we'll take that proxy of oil, which actually trades exactly like oil as well. ETF. It does have some service sector in here too as well. So remember, it's not verbatim. It doesn't trade actually 100%, but it does follow crude oil. If you want an ETF just for oil, then you would trade the OIL ETF. However, that doesn't trade as well as USO. It's not as deep as far as the market itself. Okay, we are coming into some big price support here. I like the crude oil for trade here. And what I mean by that is your counter trend trading, meaning that if you are looking for a bounce to the 200, I'd be looking for something in these areas and only in these areas. The USO has a lot to prove itself. Crude oil has a lot to prove itself that we are actually changing trends. Now, for a bounce trade, because we are extremely oversold here, you can look at USO taking out 34 or dial down to obviously a 5-minute or a 15-minute or a 30-minute chart, depending on your trading plan, and look for an entry there just for a trade. Because why? Your stops, easy to manage, are going to be below yesterday's low. Okay, so better buy here in USO for a counter trend trade. Okay, it's going right into the indexes. As you can see here, Spiders Daily, we are now hovering above the slanted of support, which was resistance, and we are now just underneath the November 2012 uptrend line, which is in red here. Okay, bunch of dojis, a lot of indecision. So there's a tug of war going on here. Do we break out? Absolutely, we can break out. Do not deny that. And I wouldn't deny it either, that the markets can indeed move higher. So, but we are extremely overbought. We're grossly overbought daily, weekly, and monthly charts. So when that happens, I would use a word of caution. That's all. Okay, IWMs. The weakest of the five, one of our leaders here actually had a little bit of a pause yesterday. Market started selling off hard and recouped a lot of its losses, and basically closed virtually unchanged. I think down just under $5. But again, IWMs again looking weak. This is not what you want to see. One of the leaders, the diamonds, Dow Jones proxy, again underneath this area. Looking like a triple top, if you will, 1, 2, 3, actually 4. So let's see if we get the diamonds can actually move higher here. But again, I think the markets are extended, and I think the markets are indeed looking for a pullback to unwind these overbought readings. And let's just see what we have here. Next would be the banks. Now the banks are definitely not following what the market is doing, and that is a bad sign, because you want the market to be following what equities are doing. You want the banks and the financials, at least, if not leading, following what the other sectors are doing. And you can see here the transports are doing fantastic, and that's because of a weaker crude oil. It's obvious. You have trucking, railroad, airlines, they're all up, and the airlines are making all-time highs because fuel is cheap. So it puts that cheap crude oil price, that petroleum, the jet fuel, props up their bottom line. So actually working out really well. But again, when you have the transports at these levels making all-time highs a couple days ago, you have to be very, very cautious here. Okay, and here's just the XLF to show you again that we not participating. Goldman just sitting under here. Watch Goldman. I would be stalking Goldman for a big breakout. If Goldman does break out and the banks start to follow suit, then I think you're going to have a big target. It's going to be at the 170. That's what I'm still looking for. Easy to manage here, guys. Below this area here, below that 50, or even below this area here, depending on your trading plan, you can take your stop, one of the two, with a breakout of this area here. So again, keep in mind, I still like Goldman. I think Goldman's still hovering nice, consolidating here, building energy to explode high. Now, if that does happen, you should have some of the banks start to follow suit, and then that could actually kick off another rally in the markets. Apple holding in nicely up here. Again, to me, no trade. I think Apple's a little extended. I think Apple can go to its highs, absolutely, 540. No reason why it can't. But for me, risk reward, I'd rather see Apple back down to the 50 and look to buy it. It's a little bit better to manage. And then Apple sitting up here had this huge run, and then now just hovering this area. And we have the IGN, which is the networking sector, part of tech. We did get a bounce back up, and usually when you break that head and shoulders, you do kind of get a back test, and then let's see if it fails and holds this area. That's the target, is 2704. But right now, as you can see, part of technology within are weak, and that's not a good sign. You have banks and financials not following what's going on with the equity rally, and again, we actually have a lot of the ETFs, the indexes, actually moving and not stocks. Now, certain stocks have moved 80, 50, 80, 100%. A lot of stocks did move, but now they're just either gapping up, going sideways the last week and a half. And as you can see, based on a lot of the indicators, they're not really giving us any more reading that the markets are indeed moving higher all in one. So that's what you want to see. You want to see everything in sync, all the engines running at the same time. When you have different sectors moving higher, again, such as bonds. Bonds are starting to roll over. You have the utilities higher. You have consumer staples, healthcare. These are all safe haven sectors where people like to hide their money when in time of turmoil. And right now, you have a lot of these sectors moving to the upside, which is telling me people are rotating out of higher beta names. The Russell is a great gauge of risk. That's why Russell's been beaten down. Money's coming out of Russell. Looks like it's going into the safe haven sectors, such as the utilities, healthcare, and the consumer staples. So again, be very careful out there. Markets are in this euphoria of buying, and we're all one-sided. When that happens, it doesn't end well. All right, guys. A little long-winded. I do apologize, but I wanted to get a couple points out for today's trade. Have a great day. Use your stops, and we'll speak to you tomorrow. Take care.